Okay, good morning to you again, everybody. I'd just like to warmly welcome you all and to acknowledge the presence of one of our directors, Mr. Lancelot Jack, who always makes the time to share these fora with us. CEOs of the banks, I'm not seeing Kelly, the Executive Director of BAT, if you're here, President of ATIC, all the CEOs here with us this morning, all the representatives from the commercial banks, insurance companies, the chambers of commerce, members of the media, central bank staff and retirees, all other guests and members of the public who are joining us via the live stream. Thanks so much for coming to the presentation of our Financial Stability Report 2016. Allow me to acknowledge the members of the head table. So we have Governor Dr. Alvin Hille, in case you don't know. Next to him, we have Michelle Chung-Tai-Bell, who is the Inspector of Financial Institutions, acting as Inspector of Financial Institutions. And then we have Michelle Francis Panto, who is the Deputy Inspector. These two ladies and gentlemen will make the presentations this morning, starting with Michelle. Well, we have two Michelles, so starting with Michelle Chung-Tai-Bell, who will talk about assessing resilience in the domestic financial system. The other Michelle, who will focus on promoting financial stability. And then Governor, who will do a presentation on the imperative of strong corporate governance for financial stability. As is customary, we will open the floor for your questions, and we will do our very best to respond to you. So welcome, Michelle Chung-Tai-Bell, to the podium.
Thank you, Nicole. Good morning, ladies and gentlemen. Thank you for taking the time to be here with us today, to give us the opportunity to share our thoughts and engage with you about our Financial Stability Report. Now, my role would be to give you the highlights of the first few chapters of the report dealing with the global and domestic macro-financial environment. I'll also do a review of the banking and insurance and pension sectors in 2016, and then I'll go into an overview of what we think about when we assess the resilience of the system. Then next, Michelle Francis Panto, our Deputy Inspector, will follow with an update on what we've been doing here at the bank to advance important legislation and to ensure proactive and effective oversight of our financial institutions. Then the Governor will close with a discussion on corporate governance and why it is so important for financial stability. When there are problems in the banking or in the insurance sector or in other areas of the financial system, yes, depositors can lose money or insurance policyholders can lose their life savings. However, when we talk about systemic risk of financial instability, we're not just talking about the failure of one firm. We're looking at the bigger scheme of things. We're looking at how the failure can exacerbate or create economic downturns, affect monetary policy, trigger capital flight and exchange rate pressures, and even require public funds to rescue troubled financial institutions. Also, rising interconnectedness through trade and among financial institutions can cause financial shocks in one jurisdiction to quickly spill over across financial sectors and national borders. As we are all too aware, a problem in one institution or even a rumor about a potential problem can shatter confidence and precipitate runs and ripple through our entire financial system. Our regional financial institutions are becoming even more interconnected. We're seeing a growing presence of complex groups with operations throughout the region, controlled by holding companies, some of which have extended their footprints beyond the region. It is public information that in 2016, the largest bank in Jamaica, NCBJ, acquired a significant shareholding in Guardian Holdings Limited, the largest regional insurance player. We also saw Sagicor responding to the downgrade of Barbados by redomiciling from Barbados to Bermuda, a well-known offshore financial center. Our banks continue to exploit technology to drive efficiency, reduce costs, streamline processes, and to enable new distribution models. They have expanded their range of services beyond the ATM and links they offer in telebanking, e-banking, and mobile apps. Trinidad and Tobago serves as a regional center for a number of international banks successfully operating under a shared services model for their Caribbean operations. This business model relies on telecommunication networks and decentralized or outsourced elements, oftentimes in far-off places, even as far off as in India. And these linkages create the potential for propagation and amplification of cyber and other risks. So with all this in mind, our financial stability monitoring starts with an understanding of the wider environment and the global forces at play. Advanced economies continue to face risks associated with low growth and a prolonged period of low interest rates. Economic growth in Latin America and the Caribbean has been weighed down by depressed commodity prices, sluggish global growth, and structural challenges. In the Caribbean, fiscal vulnerabilities continue to pose financial stability risks. Low growth coupled with high and rising debt levels have triggered downgrades across the Caribbean region. Also, the loss of correspondent banking relationships in jurisdictions such as Belize, the Eastern Caribbean, and the Bahamas have alerted us to the seriousness of this threat to financial stability. And with that as a backdrop, there are many similarities and differences in the financial stability concerns globally. Our scan of recent financial stability reports reveals concerns about low to long commodity prices, and that's very familiar to us, in Canada, Middle East and Asia, and Latin America and the Caribbean, and their concerns about asset quality deterioration in non-performing loans in North America, Europe, and in the Middle East and Asia. According to the IMF's April 2017 Global Financial Stability Report, financial stability has improved since their last assessment in October 2016 due to improvements in the global macroeconomic, credit, market, and liquidity conditions. However, the game changes in 2016 were related to political events, Brexit in the UK, and the election of Trump in the US. Since the November 2016 presidential elections in the US, there are concerns that the US could implement trade protectionist measures and the global agenda for financial regulatory reform could be derailed. President Trump has been reported to have said that he intends to do a big number on the Dodd-Frank Act. A withdrawal of commitment for the G20 Basel post-crisis regulatory reforms could have ripple effects in our environment and undermine our regional efforts to harmonize banks' capital requirements with international standards. Michel Francis Branto will tell you in a short while about where we are in that process of implementing these international capital standards in our banking sector. Material differences across our region can lead to regulatory arbitrage, deterioration of capital buffers, and in bad times, test the resilience of our regional financial system. In a recent speech, Mark Carney, the governor of the Bank of England and chair of the Financial Stability Board, reiterated that full, timely, and consistent implementation of G20 reforms remains essential to deliver a financial system that supports growth in the short, medium, and long term. So we must finish the job to build the level of resilience our citizens deserve. So let us all hope that good sense will prevail. So what about our financial system? As you can see from the chart, total domestic financial sector assets remain somewhat flat. Assets held by banks, insurance companies, and pension plans that are supervised by us at the central bank account for approximately 80% of domestic financial sector assets. Of course, commercial banks still dominate at $145 billion, and they account for 44% of the financial system assets. And together, insurance companies and pension plans account for another 30%. In last year, we highlighted, at the same forum, we highlighted what, in our judgment, the key risks to financial stability that could test the resilience of our system. There were persistent low energy prices, household financial stress and a correction in house prices, a spike in long-term US interest rates, and sovereign debt restructuring in the Caribbean. And at that time, at this very room, the governor also spoke about the persistence of the terms of trade shock, and he said to us that notwithstanding the country's buffers to deal with the economic situation, such as our Heritage and Stabilization Fund and our stock of foreign exchange reserves, the prudent thing for us to do would be to consider the shock as long-lasting and utilize the country's available buffers at a measured pace while making more fundamental adjustments. That's a quote from your speech, Governor. We also told you that the challenges within the domestic and macro environment stemming from the fall in energy prices had not by then translated into any material decline in the key financial soundness indicators of the banking and insurance sectors. Credit, market, and liquidity risks appeared contained, and the insurance sectors were stable and institutions were well capitalized. And we said then that the system is resilient and we had no financial stability concerns. Well, 1 year later, while much has changed in the global landscape with after Trump and Brexit and so on, much has stayed the same here. Our selected financial stability indicators indicate a banking sector that continues to be liquid, has maintained its capital buffers, and to date has not seen any material deterioration in overall the quality of their loan portfolios. The banking sector continued to record healthy profits, and the increase in interest rates positively impacted bank profitability in 2016. And banks used that space to write off some long-standing non-performing loans and shore up the balance sheet in their overseas operations. Profitability as measured by return on equity has been in the double digits over the past 5 years, peaking at 19% in 2016. Now, a parallel might be drawn with Canada and Australia. Last year, Australian banks returned 13.7% return on equity, and in Canadian banks, 14.1%, down from the prior year due to the impact of lower commodity prices. Now, Australia has 4 big banks and Canada 5. And also like Trinidad and Tobago, the financial sectors in those 2 jurisdictions were relatively unscathed by the global financial crisis. This is in stark contrast to the United States and the European banking sectors, which spawned the 2007-2008 financial crisis. Higher capital held due to revised international standards, coupled with the negative impact of ultra-low interest rates, the ultra-low interest environment has driven bank returns even lower than in those jurisdictions, even lower than before the crisis. At the end of 2016, European banks' return on equity averaged just 5.8%, and the United States ended the year at around 7 or so percent. Looking now at the life insurance sector, overall reported capital ratios of the order of 20%. Premium income increased due to the large one-off premium because of the wind-up of the Metal pension plan. Those assets, those liabilities were purchased by the insurance sector. So you'd see the pension sector shrunk by about 800 million, and those assets went into the pension sector. Reported profits in the life insurance sector have been volatile due to, in part, to certain accounting policies. In particular, in 2016, there was a significant increase in profits due to the impact of foreign exchange fluctuations and adjustments to actuarial liabilities. Now, insurers are preparing for the adoption of significant new accounting policies, IFRS 9 and IFRS 17, and those may or may not dampen the volatility. The non-life insurance sector's profitability continues to be adversely affected by the low interest rate environment and pricing pressures in an increasingly competitive market environment. Occupational pension plans continue to experience depressed investment returns, and many plans are faced with having to increase contributions to pay for promised benefits. The challenging macroeconomic environment increases the risk that sponsors will be unable to meet the increased costs to provide these benefits. On the other hand, any potential increase in interest rates or foreign exchange gains can improve the plan's funding positions. Over the past few years, sponsors have been addressing the funding risk through closure of defined benefit plans to new employees who are now covered under defined contribution arrangements. Now, the financial soundness indicators we've been speaking about, developed by the IMF, are based on financial statement data, and they're a tool in our analytical framework that we use to assess the current balance sheet strength, liquidity, and profitability of our institutions. But they're mostly backward-looking, and they do not account for the potential of contagion or interconnectedness within our systems. So when we at the bank assess the risks and vulnerabilities of our sector, we dig deeper and we use other indicators, including stress testing, and a fair amount of judgment to think about the potential for financial instability and to try to understand the ability of our system to weather the storms, which is our resilience. So as an example, I'll walk you through the thought process and what we're looking at to assess the banking sector's ability to withstand heightened credit risk. Now, interest rates in Trinidad and Tobago have been low for some time. When low interest rates first appeared, the impact was most noticeable on pension plans and insurance companies. But a sustained low interest environment can affect the banking sector as well. In this environment, there's a danger that banks would try to grow their earnings and asset base by fighting for market share, weaken underwriting standards, increase fee income activities, reduce expenses, and enter new markets and increase their proportion of riskier assets. Of more concern even, when consumers and businesses become accustomed to the no rates, they tend to increase their leverage. So the flip side of that coin is that if interest rates start to climb, the transition to higher rates could be very painful. This is a scenario that has played out in many, many jurisdictions globally, and as a consequence of a low interest rate environment. And so we know from that experience of looking at others, we know how bad it can get and the consequences. So the central bank has been monitoring the growth in lending portfolios very carefully. Motor vehicle loans grew by 12% in 2013, about 19% in 2014, and 22% in 2015. And I guess not unsurprisingly, it slowed to 7.5% in 2016. But notwithstanding the slowdown, the largest growth in consumer loans in absolute terms continues to be in the motor vehicle and real estate segments. And there was a marked increase in credit card usage, and the pace of debt consolidation has doubled. Note that there was little growth in the business sector loans over the last 5 years. So in the current economic environment, and given the high growth in certain sectors, in our assessment of risks and vulnerabilities, certain loan portfolios may be vulnerable to a spike in delinquency. And we've also been monitoring non-performing loans and past due loans very carefully. And although the overall ratio to non-performing loans to total loans has been reducing from 6.2% in 2011 to 3.7% in 2015, down to 2.7% in 2017, there has been a recent uptick in certain sectors. And in certain consumer sectors, non-performing real estate and related lending loans increased from 1.3% to 1.5% in the last quarter of 2016. Motor vehicle loans, non-performing loans increased from 0.5% to 0.9%. That's almost doubling in one quarter, in the last quarter of 2016. And the non-performing loan ratio for all other consumer loans increased from 1.6% to 1.9%. Credit card delinquency, we saw a slight uptick also in that last quarter of 2016, going from 2.2% to 2.5%. So that's non-performing loans. What we also look at is past due loans, because any change in the level of past due loans is a leading indicator of potential migration to the non-performing category. And so far, we've not seen any major increases that are giving us a cause for concern, but in the environment, this is something that we're looking at very carefully. But again, these are backward-looking indicators, and if we think that there are potential vulnerabilities, we tend to also think about the triggers that could allow these risks to materialize. And the triggers, of course, would be rising unemployment, rising interest rates, which would affect repayments on variable rate loans, rising inflation. So in terms of our framework for assessing risk and vulnerability, we having thought about the vulnerabilities, understood what the triggers are, what do we do to assess resilience? Well, we've been operating a stress testing framework. It's a single factor stress testing framework since 2011. And based on the results of the stress tests, to understand the potential impact for deterioration on the capital and financial condition of the sector, we don't have any major concerns, but our risk assessment is that risk of deterioration in NPLs is elevated. And capital, of course, is just one line of defense, but the other is close management and proactive management. In our current environment, banking institutions have instituted closer monitoring of at-risk sectors, and obviously early delinquency is being monitored. And on our side, our supervision teams have been proactively engaging with banks to focus on monitoring of the quality of loan portfolios, the quality of underwriting, and we're undertaking a thematic review of credit and concentration risks in the sector. So I've described the approach for credit risk, and in the report you'll see we've looked at two other risks, sovereign risk and market risk. And why do we do this work? Now keep in mind, and this is important, it's not about predicting the future. It's an ongoing process because the world is changing every day. We're constantly scanning the environment, engaging with institutions, and applying judgment to understand and to focus on the things that can go wrong so we can craft our responses to them and to be prepared. Our mantra is we want no surprises. And again, it's not about predicting the future. It's about understanding risks and vulnerabilities and allowing us to use fora like these, a forum like this, to allow us to raise awareness and to promote actions to either reduce the probability of occurrence or the magnitude of the impact if the risk does occur. And this is the approach that allows us to sleep at night. So the banking sector's stability indicators of credit, market, and liquidity risks appear contained, and the insurance sectors have been stable, and the central bank has no major financial stability concerns. We believe that our system is resilient. However, we remain continuously vigilant. And we understand that while financial system vulnerabilities may increase susceptibility to shocks, strong capital buffers, effective governance and risk management, and proactive supervision and regulation help to promote financial stability and strengthen resilience. So with that said, I'll pass you on to Michelle and the Governor to give you more insight into what is driving the way we supervise the sector and our strategic priorities on the supervision, research, and regulatory fronts as we promote resilience of our sector. Thank you.
Thank you, Michelle, for that overview of key risks and vulnerabilities. My presentation complements that discussion as it really focuses on the initiatives we are undertaking to promote financial stability in collaboration with other stakeholders. In 2016, the Central Bank developed a new 5-year strategic plan, and this plan is posted on the bank's website. The plan identified 3 themes, 10 strategic objectives, and 23 strategic projects, of which 7 are aimed at promoting financial stability. The 7 strategic projects are identified on this slide, but in the interest of time, I will only speak to key developments in 4 areas, namely advancing legislation, improving risk-based supervision, improving governance standards at financial institutions, and taking stock of developments in payment systems. More information on these topics can be found in chapters 4 and 5 of the report. In terms of legislative developments, last year we would have done detailed presentations on the insurance bill and FATCA legislation. We are pleased to report that there have been some developments in these areas. The insurance bill was laid in Parliament in July 1, 2016, and is currently under review by a joint select committee. The Central Bank continues to push for its enactment as the insurance bill contains critical provisions to improve the governance and risk management practices of financial institutions, including capital adequacy requirements and prudential limits. Additionally, after much excitement, the Tax Information Exchange Agreement Act was enacted on March 20th, 2017, but is awaiting proclamation, which is expected around August of this year. While the Board of Inland Revenue is the competent authority for receiving the tax information, the Central Bank, as well as the Trinidad and Tobago Securities and Exchange Commission, are tasked with developing guidelines to give effect to the legislation. A draft guideline has been developed in collaboration with the Board of Inland Revenue and the Securities and Exchange Commission, and the Central Bank has consulted with its regulated entities. Similar to FATCA, Trinidad and Tobago is required to now comply with the Global Forum's Common Reporting Standards, or CRS, which was released in 2014, and which provides for the annual automatic exchange of tax information or financial account information between governments. Currently, Trinidad and Tobago is one of 3 countries, the others being Micronesia and Guatemala, that is non-compliant with the CRS, and is required to commence the exchange of tax information by September 2018. To this end, the government of Trinidad and Tobago has drafted the Mutual Administrative Assistance in Tax Matters Bill, and this was introduced in Parliament on April 21, 2017. And consultation on the bill is in progress. On a positive note, the reporting procedures currently being implemented for reporting under FATCA will also facilitate reporting under CRS as well. Turning now to AML-CFT matters. Last year, the country's mutual evaluation report was published. We advised that the country had been placed in enhanced follow-up and was required to report back on initiatives being undertaken to rectify its deficiencies by May 2017. To date, several actions are in train to cure the deficiencies. On the legislative front, several bills to strengthen law enforcement and prosecution on AML-CFT matters were introduced in Parliament this year. Also, an action plan and national risk assessment to address identified gaps in the country's AML-CFT framework has been finalized by the NAMLAC and is awaiting ratification by Cabinet. Institutionally, the Central Bank has been working on revising its AML-CFT guideline, developing a policy for the regulation of money remitters, and we have been chairing the Supervisory Working Group of NAMLAC in order to develop legislative proposals to amend the Financial Obligation Regulation, which details its supervisory framework for financial institutions and listed business. At the May CFATF plenary, which was held in Trinidad and Tobago, the Central Bank, the country outlined all the initiatives being undertaken and was commended for the actions taken to date to close the AML-CFT gaps. The initiatives being undertaken on the AML-CFT front, as well as those being taken to address tax compliance, will go a long way in helping to mitigate the threat of de-risking. Last year, the Central Bank also reported that it was in the process of implementing Basel II. Basel II implementation is a priority of the bank over the next 5 years. Regionally, Basel II implementation is also high on the agenda, and this work has been spearheaded by the Caribbean Group of Bank Supervisors. Importantly, all regional countries have agreed to adopt the simpler standardized approaches and not the model-based approaches under Basel II. And this augurs well for collaboration, comparability, and harmonization of capital adequacy standards across regional financial groups. the bank has adopted a two-phase approach to the full implementation of Basel II and III, and I will discuss this in more detail a little shortly. Also, an industry technical working group was established to ensure appropriate implementation of the framework. What then are the objectives of implementing Basel II? Well, there are several, and they are interlinked. One, to establish more risk-sensitive minimum capital adequacy requirements that would provide better quantitative triggers for prompt corrective action. Two, to provide incentives for banks to improve governance and risk management practices. The new framework allows for financial institutions to claw back capital based on improved risk management practices. For example, where acceptable and better collateral is being held against a more risky exposure, the financial institution can use the lower risk factor for the collateral in determining its required capital needs. And third, which I consider to be an overarching objective, to enhance the resilience of the financial sector. More robust quantification of risk exposures provide a better indication of available capital buffers for unanticipated risks and losses. As mentioned previously, the Basel II implementation project is a two-phased approach. Phase 1 covers establishment of the baseline minimum capital requirements for credit, market, and operational risk, and is more risk-sensitive than our current Basel I requirements. Under the standardized credit risk approach, for instance, the risk factor gets higher as the credit worthiness of the borrower deteriorates. Basel II also includes a capital charge for operational risk, which does not exist under the current standard. Operational risk is a key factor, a key risk facing financial institutions, and it makes sense that minimum capital requirements should cater for this risk. Under Phase 1, the bank will also introduce certain Basel II elements, such as a common equity Tier 1 ratio and higher minimum capital requirements. Phase 1 is scheduled to be completed by mid-2018, and we are eager to move forward on this. As we approach Phase 2, which is primarily about improving risk governance at financial institutions and includes forward-looking stress testing. Financial institutions will be required to have a process for determining their optimal capital needs, and this process must be documented and submitted to the central bank for review. The board and senior management of financial institutions are expected to be intimately involved in the determination of optimal capital requirements commensurate with the risk profile of the institution. Under Phase 2, the bank also intends to introduce further Basel III elements, namely leverage and liquidity ratios. So where are we now? A significant milestone in the Basel III project was achieved with the completion of the first quantitative impact study in July 2016. The bank has provided detailed feedback to the industry and individual institutions on their QIS results. The QIS was conducted on December 2015 data, and it showed that the minimum capital adequacy ratios for the banking system declined by approximately 3 percentage points upon application of the new rules. However, risk-weighted assets of the system increased by roughly 24%, owing to the inclusion of, one, the operational risk charge, and higher risk rates for exposures to certain public sector enterprises and banks. On average, all financial institutions continue to be adequately capitalized under the new Basel II rules. Given some observed issues in the completion of the QIS-1, a second QIS is currently in progress and will be completed in July 2017. I now turn to developments in the payment systems. And this is very topical given recent developments. Globally, there's rapid transformation taking place in payments given the emergence of non-traditional players offering new payment services, payment products, and novel processing methods. Domestically, the payment system providers are evolving, and we are observing the emergence of what is termed payment aggregators and fintech companies in this space. A payment aggregator is a service provider through which an e-commerce merchant can process payment transactions. An example of that is PayPal. Traditionally, bill payment service providers largely facilitated payments to utility companies, but have been expanding their clientele to accepting loans and deposits for financial institutions such as credit unions, which changes their risk profile. And then there are fintechs. The term fintech is normally applied to the segment of the technology startup scene that is disrupting sectors such as mobile payments, money transfers, fundraising, and even asset management. The emergence of fintech has forever changed the way that companies and people do business and has promoted financial inclusion. Millions of people can now make payments using their smartphones, and they do not need to use a bank. In terms of new products, the commercial banks have also been making improvements in their traditional payment services. Many banks are offering internet and mobile-based solutions, open mobile banking solutions, including mobile banking apps and mobile point-of-sale apps. The latter enables a device to be wirelessly connected to the merchant's smartphone or tablet to accept credit card payments. We are also observing the emergence of digital currencies, more specifically virtual currencies on the local landscape. Digital currency is defined as a digital representation of either a virtual currency, which is non-fiat currency, or e-money, which is fiat or real currency. Virtual currency is a digital representation of value that can be traded and functions as a medium of exchange or a unit of account or store value, but does not have legal tender status. Many of you would have seen that Trotters is accepting Bitcoins, and recently persons were inviting the public to an information session on OneCoin, which is a type of virtual currency. Currently, the Financial Institution Act allows for entities licensed under the Act to issue e-money. Some banks have issued e-money products in terms of prepaid cards, and they have also issued co-branded cards with telecoms and other persons and other service providers. The central bank is currently developing an e-money policy which will allow other entities than those licensed under the Financial Institutions Act to issue e-money. With respect to virtual currencies, however, internationally there's no consensus on how they should be regulated, although a lot of developments are happening in respect of that issue. While being touted as a solution to deal with de-risking and financial inclusion in some quarters, there are also risks associated with the use of virtual currencies. However, the technology underlying the virtual currencies, that is the distributed ledger technology, has potential to improve efficiency of payment services and financial market infrastructures. In light of this, and not wanting to stifle financial innovation, many regulators have been adopting what is being referred to as a regulatory sandbox approach in an effort to better understand the new innovations in the payment space. Regulatory sandboxes provide a set of rules that allow for testing of products and business models in a live environment with minimal legal requirements. These programs usually have certain predefined experimentation criteria, such as limitations on clients, time limit testing, predetermined exceptions, and testing under regulatory supervision. Examples of countries utilizing the sandbox include Bahrain, UK, Canada, Singapore, and Hong Kong. The central bank is looking at these developments and is aiming to develop a policy paper on virtual currencies within the next couple months to guide its approach for treating with virtual currencies in Trinidad and Tobago. Meanwhile, the central bank would like to advise potential users of or investors in virtual currencies to obtain as much information as possible on these currencies, as these instruments are not regulated by the central bank and can be very volatile. Rapid technological developments have spurred growth in online usage of making payments, sending remittances and conducting banking and financial services have opened up a new playground for criminals, and as such, cyber risk and cybersecurity is now a growing concern. Cyber attacks have morphed beyond the ATM card fraud and data breaches to include the more sinister use of ransomware to hijack computer systems, with ransom being demanded most times in Bitcoin. As a consequence of skimming and data theft concerns, banks have been adopting the EMV chip and PIN technology for payment cards. This technology was established by Europay, MasterCard, and Visa, and the embedded microchip on the card stores data more securely, preventing it from being copied or altered. The recent WannaCry ransomware attack in May 2017 affected at least 200,000 computers across the globe. Ransomware is a malicious software designed to block access to a computer system by encrypting a user's files until a sum of money is paid. And a ransom of US $300 to $600 was to be paid in Bitcoin for a key to unlock your data. Central banks have also been affected. In 2016, the Bangladesh Central Bank lost millions due to hackers using stolen credentials to access the central bank, and using SWIFT networks sent fraudulent payment messages to steal funds. It is therefore critical that financial institutions in Trinidad and Tobago reinforce their cyber resilience and cybersecurity and ensure that their institutions and customers' information and funds are securely protected. In this regard, the Bank for International Settlements in June 2016 released its publication on guidance on cyber resilience for financial market infrastructures. It requires that payment systems have sound risk management and governance arrangements in place to mitigate risks, including cyber risks. So what then? So turning now to what the central bank is doing. The central bank has been amending its regulatory framework for payments, and I discussed those initiatives earlier. In 2016, a cyber governance health check was also conducted, where institutions were asked to provide information on what they are doing with cyber risk. There's a regional cyber information security, cyber information sharing group that has been established, and this is the regional central banks have established that group and for sharing information on cyber attacks. And there's also a Caribbean FinTech working group that has been established to look at the impossibility of using looking at financial innovation throughout the region and how it can be used to prevent de-risking and financial inclusion. So those are the major developments that have been going on across the region and at the central bank in terms of dealing with payment systems. And I now thank you for your attention and hand you over to the governor, who will go into governance.
Yes, thank you very much, Michelle, and Nicole. Welcome everyone while I load the presentation. Thanks for taking the time to be here on what turned out to be a gorgeous Tuesday morning in Port of Spain. I mean, it started off very rainy and wet, at least where I was living. And I think it's kind of symbolic of what we might be going through in Trinidad and Tobago. So with the right attitude, action, concerted plans and collaboration, including in the financial sector, we will get back to the gorgeous times. So this is a message for all of us on how weather could be used for our own lives. So what am I going to do and why am I going to do it? We have a situation where, as was mentioned before, we basically have a sound financial system in the country, and we're happy that we could boast of that. But of course, we need to be careful. We need to be vigilant. We need to be concerned about what may be happening on the macro front. We all know the terms of trade shock we experience. There's no secret to that. We know it affects the fiscal situation, the balance of payments, foreign exchange, and so forth. We are living that. But of course, we have to be careful that we do the right things. And one of the things that I want to highlight in this brief presentation is the issue of governance, strong corporate governance, particularly in the financial sector, because if you don't have that, then you could have problems that create issues that then emerge into situations that could be very destabilizing, not only for the particular institution, but it could morph into something much, much larger for the rest of the system, and then even go abroad. So we have to be very careful, and it's something that is not sometimes widely brought to the fore, but I think it needs to be, because unless we do that, then we could be missing something that is quite fundamental. So let me see if I can get this thing to work. All right. So don't worry about the main points. They look long and they will be looking kind of boring. But at 11:15, I'm promised that this will be on the website. You'll have the actual speech which has all the points there. We'll also have the presentations and so forth, so you could look at it at your leisure. We didn't want to give you it now to distract you, but you have all of that to deal with. So let me turn to the start of the presentation. I'm starting with the global economic context, because one of the things that we are quite familiar with is what happened in the global financial crisis. And what the crisis did was to bring into sharp relief the dangers that weak governance in financial institutions can pose for economic stability. Now, we have different things that are going on. You have governance weaknesses, as I will be talking about a little later. You have economic developments, economic problems, situations that are changing, new products, and so forth. You have supervisory gaps that we all could be aware of in the US, in Europe, in Trinidad and Tobago, wherever, in the world generally. We have subprime difficulties, and we are familiar with that as a main catalyst for what happened. And when people try to recount what happened in the financial crisis, the global situation, that is, they would say, well, the banks were lending to borrowers that should not have qualified. And because of changing market situations, this then morphed into something big, right? But as we will talk about, this was just part of the problem. We have economic difficulties, and what happened? We have a situation now where, like in nuclear bomb type fashion, we have something that is sparked in one part of the world and then just grows, morphs into not only something that affected the banks that were giving these loans, but it went into other financial institutions in the US. It necessitated rescue packages and so forth. And then it spilled over to the rest of the world, into our own system, into parts, into commodity markets and so forth. So what started off as a problem in a specific area then went into a global economic downturn. So you could see the importance of interconnected financial markets and a problem in one jurisdiction spilling over into another and into the rest of the world and into different markets. But the point I'm trying to get at is that it was not just economics. It was not just interconnected markets and all those things. It had to do in part, and in a major part, with governance. But we see the importance of this crisis and the impact on unemployment, on lost output, financial instability throughout the world, and bailout costs to taxpayers in the US and in different areas of the world. Now, what was as I said, even the question of whether it was a governance problem was somewhat, you had different schools of thought. Some said that the governance framework was poor. Others said, well, you know, the governance framework itself was not that deficient, but it was implementation that was an issue. So we'll get into those things a little later. Now let me go at the company level, right, the individual banks. Incentive systems, how you remunerate people, how you train people, how you give them rewards and so forth, can sow the seeds of failure in the absence of diligent oversight, because people could end up getting into a lot of risky activities, and this creates its own problems. But let me go back into just a sort of a general definition of corporate governance. And according to the OECD, or the BIS, you could consider this as a set of relationships between a company's management, its board, its shareholders, and other stakeholders. But the presence of an effective corporate governance system within an individual company or group and actions in the economy as a whole helps to provide a degree of confidence that is necessary for the proper functioning of a market economy. So you see in that encapsulated position the importance of having a strong framework, because it affects not only the company, as I said, but also the economy and confidence and trust in the financial system as a whole. And when we get into Trinidad and Tobago, this will become even more immediate for us. So, all right, we'll get into some of these things, but if you look at the chart generally, you see issues of remuneration and incentive, risk management controls, board practices, shareholder rights, all of these things, if they are not well done, then you could create a problem. And this is what we had in the US, where you have a number of banks either failing or being taken over or having big bailout packages and so forth. So we need to be very, very clear on that. If you don't have this sort of thing, then you could have a situation where the climate is very fragile and abrupt changes in market sentiment can lead to large-scale deposit runs. So public trust and confidence are therefore essential, and good corporate governance helps to set a basis for that assurance. So let me go into the international experience, and Michelle 1 and 2, I think both of them talked about it, about because of the situation in the US that went into other areas, you had some learning from that and some attempts to shore up governance internationally. So we have this billboard, and then we see some of the things that may have come out of this thing. The Dodd-Frank legislation. In this case, this was the full name is the Dodd-Frank Wall Street Reform and Consumer Protection Act, was passed in 2010, and some of the objectives were to address risks to the stability of the U.S. financial system, in part creation of a Financial Stability Oversight Committee or Oversight Council, end the too big to fail bailouts of large complex financial institutions, increase transparency and regulation for certain complex financial instruments, and strengthen protections for consumers and investors. So this was a major bit of legislation to try to, albeit belatedly, to pull back some of the things that may have led to the debacle in the US, including on the governance front. Regrettably, we heard that just last week there was a vote in the House of Representatives that may actually roll back a lot of the Dodd-Frank advances. So let's see how that goes. It still has to go to the US Senate, but anything could happen now. So this is one thing in the US. Of course, it would have been, the lessons would have been spread throughout the world. So in the Group of 20, the Organization for Economic Cooperation and Development, the principles of core governance, they already had those, but they were significantly strengthened over time so that there would be a more intense focus, not only on governance of generally, but in financial companies and institutions in particular. Then you had the creation of a Financial Stability Board in April 2009, again internationally, which marked an important step in the intensification of international coordination on financial governance and stability measures. So this again was important to see how the world was coming together, particularly in Europe, the US, and the developed countries, to improve their understanding of what happened, to coordinate to prevent problems in the future, and to make sure that things would not happen in the same way, and to find some way of not only forestalling, but to the extent that something did happen, to be able to pull things back together. So that's, a lot of these things are very important in terms of setting the stage. In the Caribbean also, we have the Caribbean Group of Banking Supervisors, and our supervisors are part of this effort. This was established since 1983 to look at issues across the common issues of supervisors, so that with the Bank of Barbados, the Bank of Jamaica, Central Bank of Trinidad and Tobago, their supervisors meet and go through things. But certainly over the last few years, there has been much more intense effort to collaborate. One, because of the experience of different crises, and two, because of a lot of new, I shouldn't say new, but emerging phenomena of cross-border acquisitions, where capital movements, of course, but acquisitions and financial mergers, investments, and so forth. So therefore, when you have a financial institution that is in Trinidad and Tobago, but it has links with or has an investment or is a subsidiary of a company in Jamaica or in Barbados, which is quite common now, then regulators have to be able to put their forces together to understand what is happening in each jurisdiction and to be able to forestall the possibility of what you call regulatory arbitrage. In other words, the possibility that a company would say, I'm going to the jurisdiction with the lowest regulations because they will tell me I could get away with a lot. So you have to be able to coordinate to make sure you understand this. So this is a very live and important set of relationships that have been developed and are being intensified over time. And of course, we have the national frameworks, meaning that each jurisdiction, countries and so forth have been doing a lot of soul searching and saying, you know, this could happen here or it has happened here. Let's make sure we improve our situation. We'll talk about Trinidad and Tobago a little more shortly. So let's see what this has to do with our central bank. What we'll say is that major central banks were catapulted into the role of picking up the pieces in the wake of the global financial crisis. Because one, either the banks or the supervisory agencies, sometimes they were the same, were regulating or overseeing the particular institutions that created or that found themselves in problems. So it was a natural look at what the regulators were doing or would not have been doing or may have to improve. But also because in the wake of the crisis, in order to get things sorted out, the banks, the central banks did a lot of unconventional, huge, and virtually unprecedented measures. So you have all this quantitative easing and so forth, buying up paper from here and there. The balance sheets exploded of central banks and so forth. So of course, people say, well, okay, well, this is not a treasury building. This is it looks like a treasury building, but it's supposed to be a representative central bank. So what happened now is that the central banks became more under the microscope because now, although they have been, central banks tend to be laid-back creatures, you know, it might be influential, but they don't make all this, like us, you know, we don't make all this fuss, but we do our work. But in the case of the financial crisis, now they're brought into the fore. Everybody's looking at what the Fed chairman is doing and so forth, even more than before, and also how much it is spending, whether it is right, what taxpayers are involved, and so forth. So you have much more intense, and I think this is warranted, attention to governance in central banks themselves. And how had this been manifested? Again, by public scrutiny. You would see it most apparently in the US. But even at the level of the central banks, there has been a lot of collaboration. One important body that has been formed is what they call the Central Bank Governance Forum, which was launched under the aegis of the Bank for International Settlements to foster good governance of central banks as public policy institutions. I would point at a 2009 report commissioned by this forum entitled Issues in the Governance of Central Banks. And I think this would be something that the nation as a whole should take a look at, because you have a central bank here, you want to know what are we doing, are we doing our job correctly, what happens in the rest of the world, and so forth. So some of the things that are pointed out in this report was the importance of the central banks having a certain set of guiding principles as a whole. Now, of course, the report does highlight, and I think we all know that central banks function in different jurisdictions, and these jurisdictions are marked by differences in size, complexity of financial institutions. Some of them have a number of different countries to deal with. For example, in the Eastern Caribbean Central Bank or the European Central Bank, you have a number of things. So they could be very complex, they have different things, but at least the main frameworks are, the main principles are fairly standard. Some of these would be clear and well-specified objectives to carry out the monetary and financial stability functions, as Michelle had talked about. Our financial stability objective is one of our objectives. The other one is monetary policy. And then we also have, within that, our internal operations to guide our efficiency. So it is important for central banks to have well-specified objectives, appropriate powers and resources as embedded in legislation and operationalized in decision-making processes, close alignment of objectives and incentives, especially by way of transparency about such objectives, procedures, and the stewardship of resources in order to assure accountability. So we are not let off the hook. In this search for improved governance globally, not only financial institutions, but central banks as part of the financial landscape have to be more accommodating and have to step up their act. Let me go into some, so in this case, this is a schema that was drawn up by somebody from the IMF that looks at behavior and culture and so forth, independence, operational independence, and all of this sort of thing. So you could look at that when you have the time, and some of the references were also available. Let me go into another area in which improper governance could have manifested itself. Now, what I talked about is at the individual company level, where you may have somebody that is dishonest, lack of integrity, or whatever. They do something, or the corporate culture itself is not sound, and it creates problems. So I went through all that. But you have some very interesting situations where you could have collusion. So different banks or different financial institutions come together and said, well, we could manipulate the price of something for what? For profit, for our own selves, or for our traders who are in this thing. So this is quite important to know, because it means it could give you pause as to the integrity of certain well-established statistical or other indicators that people use as benchmarks for whatever they have to do. Let me be more precise now, or give a couple of examples. 3 dots. What do these 3 dots mean? We had the silver prices. We had the graphics here. In terms of the silver prices, many of you would have read that quite a number of banks were charged with trying to manipulate the prices of silver. How did they do that? They may have had very big trading positions, and they said, well, let's get together and move the market in a way that would, depending on what side they're on, to either increase the price or decrease the price, because that would give them profit. So that is one example that I'm citing. These are 3 very well-known examples in the literature. The second thing, let's look at the one to the right with the bowler hat and the British flag. LIBOR. What does LIBOR mean? The London Interbank Offered Rate. Simply put, it's just a representative interest rate that is put together. You know, you have people that, or different financial institutions give information. Someone puts it together, and there you have LIBOR. And what is it used for? It is a major indicator that is used to a lot of things are pegged on this. You have people's mortgage loans. You have the prices of a number of different things throughout the world. It is extremely well utilized as not only an indicator of what is happening, but people use it for their actual transactions. Now, what happened in the case of the LIBOR, again, there was evidence of market manipulation, and a number of companies were actually fined for putting together or misrepresenting their true positions, because they said if they said, well, something was interest rates that they got were much higher, that would help to move the market up. So it was a collusive effort to put dishonest information to create the market moving in either up or down, depending on what happens. So this really rocked the world of a lot of people to think that something that was so revered as LIBOR could be part of this manipulation thing. The third example I want to give is more indirect. This is a consumer sentiment index that is put together by the University of Michigan. What does this mean? In the US, everything is very, things are so complicated and linked together that you have an index that is telling you, well, what are people thinking about the economy? What are people thinking about energy prices or about healthcare and so forth? So a little movement in this could affect the market tremendously. Not only that, you have complex algorithms that are tightly bound to this indicator. So when, let's say it is coming out on the 1st of June, by 2 seconds after it comes out, or a second after it comes out, the market could change completely, because all of these algorithms are put into this thing. And if it happens to say, well, okay, people are feeling down about ice cream, so next thing you know, the price of all the stocks of ice cream products declines precipitously. The point is not so much about the value of this index, but there was a discovery that a couple firms, unbeknownst to many people in the market, a couple firms or some firms were getting the information slightly ahead of time. And by slightly, I mean 2 seconds ahead of time. You wouldn't believe it. But because of that situation, they could be able to flood the market and change things dramatically because they had this 2-second advantage. So it was not eventually said that, this was a market manipulation or so, but the fact that you had asymmetric information was quite important. So all I want to say from these three things, the general point is that we have to be, in the issue of governance, it could not only embroil central banks, financial institutions, but actually the whole market. There could be collusion and so. So this is why it's important to be aware of this. But all of this is quite abstract, and we are in Trinidad and Tobago. So let's see what we are talking about here now. So Trinidad and Tobago's financial institution plays a critical role in mobilizing deposits from savers and channeling such funds into investments. We know this. But the point is that it is pervasive. We are a member, the Central Bank of Trinidad and Tobago is a member of the Alliance for Financial Inclusion, where you have a lot of countries around the world have joined this alliance to look at how many people are financially included, in the sense of have a bank account, know what basic things are, and so forth. We tend to be at the high end. So most people in Trinidad and Tobago have accounts, they have information, and we are well banked and so forth. So when you have a problem in the financial sector, it is not an abstract situation. People know, people are aware. They may have their credit unions, they may have their banks, they have the insurance companies, they have the non-bank financial institutions. They are affected, they are aware, they know what's happening. Financial institution assets are quite important. As a percent of GDP, if you took assets, you get it about 216%, so it's large. I'm not talking about the contribution to GDP, which is another concept, is about 15%, but this is the total assets. So it's a large thing, it's immediate to people. Not only that, we are well integrated with the rest of the world. So when you have something happening in the US or in Europe, Japan, it spills over to us because we have an open capital account, we have ability to move money quickly. And so therefore it is not it is not far-fetched that things that happen abroad affect us very rapidly. Now, in the case of the U.S. financial crisis, that was the crisis that was born there, we did have some insulation because our banking practices tended to be much more conservative, so we didn't follow that kind of thing. But the fact is that when you have markets moving, they would affect us. Now, everyone is looking at what is happening in the US with interest rate rises, and we have to be aware of those things for our own interest differential and the possibility that could affect capital movements and so forth. So in terms of, just to recap some of the statistics, we have a dominant banking sector, commercial banks about 44%. We have insurance companies, pension funds about the same, about 15%. We have non-banks, credit unions, and so forth. So this is just a trotting out of where we are. But we don't want to be misled by just the numbers and scope, because we would find, for example, the credit unions, although their formal assets are just about 4%, they would incorporate a large measure of the population. And for them, the credit union savings and the possibility of loans would be quite important. So let me go into what happened in Trinidad and Tobago, or just in Trinidad and Tobago, like every other jurisdiction, we've had our own financial difficulties and problems and failures and so. And part of this, we can attest, would be linked to governance issues. Let me just give a few examples of some of the things and some of the important or representative failures also. In the 80s, around the late 80s or so, we had the suspension of 5 non-bank financial institutions by the central bank because of issues related to a number of things, including being heavily involved in funding real estate development by selling deposits or offering deposits above market, at above market interest rates. Right? Nothing is wrong with that per se about the involvement in real estate, but when you have a real estate market that is having problems, and then you have interest rates that are too high, then you have the seeds of problems here. Then we have another situation that we're all aware of with the indigenous commercial banks that faced major economic difficulties in the late 80s into early 90s that led to a merger. Then we have most recently the CLF issue, where involving a major insurance company and its banking subsidiaries. And this shock, as we know, was quite intense. It is still being resolved, and it not only affected Trinidad and Tobago, but the rest of the Caribbean. Now, in all of these episodes, confidence was put to the test in the financial system, the fear of contagion to various degrees, and public resources utilized depending on the magnitude of the problem. But of course, situations create, or challenges create, opportunities. Just like in the US, we have the Dodd-Frank Act. In Europe, we have all the things that I talked about. In Jamaica, when they had the major problems in the 1990s, they had a substantial strengthening of legislation. And in fact, some financial institutions don't want to go there because the legislation is so tough, they say, let's hold back. So I think these are important developments that can emanate from what could be an unfortunate situation. And in Trinidad and Tobago, as we'll discuss, there were improvements in legislation, oversight, and regulation of financial institutions. But we still have some way to go. Now, where are we in Trinidad in terms of the governance framework? Our assessment is that we still have some way to go to evolve. We basically have 2 layers of governance in Trinidad and Tobago. The first one is legal and regulatory, where we have the Companies Act, we have regulators such as, this is not exhaustive. We have the Central Bank of Trinidad and Tobago, the Commissioner for Cooperatives, the Securities and Exchange Commission. We have the Moneylenders Act under Securities and Exchange, but it's not supposed to be saying that it's under the SEC. But we have a framework that involves regulators, we have the financial institutions, and we have the legislation, such as the different acts and so forth. So we will be, as the central bank, monitoring and supervising and regulating the banks, insurance companies, pension funds, and so forth under the Financial Institutions Act and Insurance Act. Then you have the credit unions under the Commissioner of Cooperatives, the SEC for the Securities and Industries Act. And all these companies would have to conform in one way or the other to the Companies Act. The Companies Act itself is rather general. It says that it requires directors to act honestly and in good faith with a view to the best interests of the companies. In the case of the Central Bank Act, the Financial Institutions Insurance Act, and so forth, there are certain stipulations with respect to governance, but also the central bank, as was mentioned before, would issue certain what you call guidelines to financial institutions, such as on fit and proper, meaning how their directors and managers and so forth should be qualified and operate and so forth. And then you have more generally on corporate governance. There's a corporate governance guideline that buttresses the financial legislation itself. In the case of the credit unions, the governance framework is less well defined. So there's more discretion left to individual credit unions on how to establish governance mechanisms and criteria for appointments to directorships and top management positions, as opposed to the ones under the central bank. So apart from that, no. So this is one layer, the legal regulatory. The second layer would be more company specific or voluntary. So you have the associations, and this is just a sample of them. The Bankers Association would have their own code of banking practice. ATIC, which is the insurance company body, would have its code of conduct, and these are voluntary, but they are, depending on the body, they may not be as specific as the other. Then you have, more recently, you have, and I think this was a really excellent initiative by many companies in Trinidad and Tobago to get together to form, to put a corporate governance code together, and quite a few companies have already signed on to this. Some of the things that are recommended in the code as best practices refer to board composition, monitoring and performance, audits and risk management, transparency and accountability, etc., in promoting increased disclosures. Now, then you have the companies by themselves will have bylaws, depending on one. The bylaws may be more detailed or less detailed. As I said, with the credit unions, some credit unions put it in their bylaws, others are less formal. Then you have your own internal procedures to how you govern yourself. So this is the basic framework behind governance. But we think clearly it needs to evolve further. Two fronts I could mention now. One is on the legislative front. We have some gaps in legislation that need to be shored up. One important one is on the insurance side, and I think a lot of work is going into that, and I would want to commend all our parliamentarians for the efforts that are being made to move this thing quickly towards passage. I think this is quite important because improving the legislation in that would be quite important. It would put more onus on boards and managers of insurance companies in the areas of risk assessment, oversight, and compliance, and really help to fortify that legal gap that we have. Then on the company side, we want to stress that it is important not just to have all the nice words, all the nice phrases and so forth. If you look at Enron before their collapse, I mean, nobody could have a cleaner, more precise governance framework, but the implementation is important. So setting it out is necessary, but implementation is critical. Let's go into what the central bank is doing. The central bank is moving to fortify its governance internally and in the oversight of licenses, because I did mention how we are, along with other banks, central banks, are in the limelight. So we need to get our act together. A couple of things that we are working on the left side is our strategic plan. So for the first time in October 2016, we published our 5-year strategic plan for everybody to see. It's on our website and so forth. I recall when I was telling our managers that we would put this on the website, explain it to staff and so forth. There was somewhat of a horror that we would, go out, the journalists would pick holes in it and so forth. And I said, no, well, don't worry about it, because if we are serious, then we need, as a public institution, we need to be accountable. We need to be transparent, and this is what we do, and we would be held to it. So we'll see how that goes. So we have 5 years. We are in month 8 now, I think, of our strategic plan, and it's 5 years starting from October the 1st, 2016. But we think that's important for transparency, for making sure that we're on the right track, and also it puts a lot of store on good governance, procurement, and so forth. Another important thing in our view was that on April 1st, 2017, we launched our whistleblower policy internally. And by this measure, staff can, if they have a major issue that cannot be solved through the normal internal mechanisms of talking to the supervisors, making complaints or whatever, in the areas of, in virtually any area, whether it's sexual harassment, bullying, some nefarious practices that they see, and so forth, that they want to call out, they have this avenue to be able to talk anonymously by phone to an external provider that would be collating this thing. Or they could go on the website and, again, anonymously from their own email account, put these things for someone to collate and report back to a committee internally to be able to address these things, because we think it's important to walk the talk and to do our own things to shore up internal governance. In terms of governance in licensees, as was mentioned before, we are stepping up the way we engage with financial institutions. We have the corporate governance guideline, we have fit and proper guidelines, but we also talk to them more. We engage the boards, we engage the managements, we engage internal auditors, risk management departments, and so forth, to make sure that we understand it, and we have certain thematic reviews sometimes that go into governance. So this is quite well established, and we are moving to improve that even further. So I'm almost finished now. But what is the general point of this thing? Ultimately, financial institutions must police themselves. And they must adhere to principles of integrity, transparency, and proper controls. You could have the best legislation in the world. You could have the best supervisor in the world. You could have the best codes of conduct, either by your agency, by the general code of conduct for the country and so forth. If you don't implement it, if you don't really do it, then you could have problems anyway. What I want to just mention here is some of the principles that we think would be important that financial institutions should adhere to. And I'll mention seven of them. The first one, which is in the middle, I don't know if I could go back on this thing. Let me go back so it will, right, it will come out by itself. Is overall board responsibility. The board itself must be responsible. They are the ones that are put there to be able to manage an institution to make sure that it functions well. So that's the first thing, the one in the center. Appropriately qualified board members. What do I mean? You must choose board members that have experience in the field that you want to have supervised or dealt with. For example, let's say you have an audit committee. I mean, I like artists and dancers and so forth, but you may need an accountant. You need to have people qualified for the job. You have an HR committee, you have a risk committee and so forth. Make sure that the people are qualified, maintain their qualifications, so they have to keep doing the work to maintain their professional standards and keep abreast of what's happening, but also that they are empowered to engage in the board meetings and contribute. There's no point in just turning up and collecting board fees and just going your way. Efficient senior management. The senior management in the organization are charged with carrying out the board policies and being consistent and really executing at the operational level. But this must be consistent with the business strategy, the risk appetite, and the remuneration and other policies approved by the board. So there must be some consistency in that. The fourth issue is on independent risk management. More and more in the world, it is understood that risk is a critical issue to focus on directly. It's not something that is just, in the background. You have an internal auditor and so forth. But what is the appetite for risk in a company, and how is this managed? We would see in the financial crisis in the US and even our situations that a lot of the problems may be because traders, individual companies, or whatever, put a big store on high profits. But guess what? High profits come generally alongside high risk. So you have to work out what is your tolerance between risk and reward and make a balance, and at least you know, so that if you have problems, then at least you are not surprised. A strong internal audit function. That's quite critical, of course, and I think that might be more standard. But these auditors must provide an independent assurance to the board to promote an effective governance process. Supportive remuneration structure. It may seem evident, but again, we have seen that if you have signals that push you in a certain direction, this is where you will go. In other words, if you are telling your senior managers, the higher reward you get, or the more of whatever you sell, you will get a big bonus. They could, if they are not careful, but there's no downside if it doesn't work. That system sets up incentives to go in more riskier and riskier avenues. So you have to have a remuneration structure that is consistent with your risk appetite and also support sound governance practices. Because if there's no penalty for being dishonest, and the more you could get away with, people will do that. So you have to have that. The last but not least of the issues is an adequate disclosure and transparency. In other words, the governance of the institution should be adequately transparent to its shareholders, depositors, other relevant stakeholders, and market participants. There's no point in having everything very murky and nobody understands what's going on. Now, these principles were actually borrowed from the Basel Committee on Banking Supervision on Corporate Governance Principles for Banks. But we think certainly they have general applicability to all financial institutions and can be tailored to different institutions depending on their size, complexity, and so forth. As one specific example, as I mentioned before, in the credit unions in Trinidad and Tobago, their formal governance structure may not be explicit. You could take a page from this thing and maybe utilize that, make sure your board members are adequately qualified, that they're responsible, your senior management is in touch with everything, risk management is well catered for, internal audit, etc. So it is of wide applicability, particularly now that the credit union legislation is being upgraded. So let me finalize now and say ultimately there must be concerted vigilance to ensure that good governance remains well entrenched. As I mentioned all the different aspects of it that we are looking at, but just to be specific, stakeholders, depositors, shareholders, regulators, investors, and so forth must insist on regular and timely access to relevant, sufficient, and reliable information. So in other words, you hold people's feet to the fire. If you are a depositor in a credit union, in a bank, or so forth, you may not be a shareholder, but who is managing my money? Are they doing the right thing? Do we have a structure that makes sense? The public, everybody, we need to be part of the whole game. There must be free communication about concerns about illegal and unethical practices. So if somebody sees something, they should be able to communicate it to the board, to the competent public authorities, and so forth. And finally, employees should insist on high standards and form an active part of the governance process, because ultimately the employees a lot of the time know what is going on, so they should have an avenue to be able to express themselves and not feel threatened by that. So let me just say that in summary, throughout the world, the movement of money through financial institutions is clearly a high value and often high risk activity, complicated further by unethical practices, often driven by perceived opportunities for quick riches. And we see that the cost of failure can be quite high and not confined to a single entity or country. We know it is impossible, even if you have the best governance, to prevent all financial company failures. And in fact, some failure or some exits and entry of market participants is important, and I think healthy in a growing dynamic system. But it should not be wild, and it should not be lead to systemic failure. But some adjustments over time would be good. Even in the financial sector, as people's needs change, investors' needs change, depositors' needs change, technology change. So we have some of this. Ultimately, explicit and unwavering focus on strong corporate governance can go a long way towards minimizing problems, including those emanating from large global and regionally integrated financial institutions. Lessons from turbulent times here and elsewhere have resulted in a growing body of literature, experiences, and avenues for collaboration that can usefully be brought to bear in how to progressively strengthen governance elsewhere and in Trinidad and Tobago. So thank you for your attention, and we look forward to your questions.
Thank you, Governor Michelle and Michelle. I'd just like to invite you to come forward. There's a microphone there. Mark, is there any other microphone? Just this one here? People can come forward and ask your questions, and as I say, we'll try our best to respond to you.
Did I wear out everybody?
Good morning.
Morning.
I have 4 questions for the governor. First of all, has the central bank stress test commercial banks for a significant depreciation of the TT dollar? Is financial stability being promoted by the continuing uncertainty over the CLICO resolution? Is the central bank's exchange rate policy a potential trigger for financial instability? And is the central bank allowing commercial banks to hike fees to ensure that they remain profitable and stable? Thank you.
Some nice questions. You sure all the questions for me? Question one, on stress tests, yes. Actually, the stress tests were done since 2011, I think. I was heavily involved in it. There were different stress tests, single factor on exchange rate, interest rates, liquidity, credit concentration, and something else. And then there was a multi-factor test that was looking at a change in GDP brought about by a financial system, problems generated from, let's say, an oil price shock or so. So that was a combined test. At the time, I don't have the things with me, but I think there was, and continues to be, a depreciation was part of the stress test because it was an exchange rate change, and that was, I think, was 30% or something like that. And this has remained standard. So the question is, yes, that has been a standard part of it. The results have been consistent, that because of the hedge position of banks and the long position of banks, and you would see it in the reports over the years, that a depreciation actually improved their situation because they were already very conservative and not exposed in that regard. So if you look back at the results of the stress test, you would see that. So that is the question one. In terms of the question two, if I understand it correctly, because I didn't get to write it, thing, so you could correct me if I have it wrong. You were talking about CLICO and financial stability. Yeah. I think, sorry? Yeah. My comments would be that clearly the CLICO CLF situation was a major shock to the economy. That happened in 2009. And the good thing is that we had fiscal resources to be able to weather that storm. Where are we now? We are in a resolution mode. I think lessons have been learned, and I think the action of the central bank, together with the government and even the population, has been to weather that storm very well, so that we have not had a contagion that has been spilling over to the rest of the economy, as in the case that we saw in the financial situation globally. So I think, but it has come at the cost of taxpayer resources. As I said, in many other countries, you don't have that buffer to be able to do it, to deal with it like that, and the spillover has been rapid. In our case, I think the spillover has been contained. We don't have a systemic problem now. Resolution is being carried out, and I think we'll try to get it done as quickly as possible. But to answer your question, I think, no, there has not been a financial stability problem, and certainly now the CLICO thing is not a contagion issue. The third one, as I recall, was something on exchange rate. What?
If the exchange rate policy is promoting instability.
If the exchange rate policy is promoting instability. All right, what is our exchange rate policy at the central bank? Or our approach to the exchange market? It is quite precise operationally. First of all, we try to promote clear signals to the market as to policy. One, we have regular interventions, which would be twice a month. We do not target a certain level of the exchange rate, but we look at different things, such as the level of reserves, market information, the demand for foreign exchange previously, and what is coming up, to be able to come up with our own amount that we want to intervene in. We don't target a level of the exchange rate per se, and we do have, but we try to minimize volatility. Of course, you would say, well, this is all well and good, but we are not in that situation. So let me forestall you by saying I agree. We do have a disequilibrium in the foreign exchange market, that is clear. But as my people tell me, we are in what do you call an early transition mode still. What do I mean? We've had a major situation in terms of oil prices and production, complicated by production, that has led to quite a depletion of our foreign exchange earnings and the fiscal situation. This takes some time to sort out. We are not there yet. We have a situation now where there's clear disequilibrium in the market. We think that over time, and as I was saying in my analogy before with the weather, that with concerted and coordinated policies that we'll be able to get through this. I think we still have some way to go. In terms of the forex market, there are three things that are important. The fiscal action, structural action, and monetary policy. All of these must be coordinated to make sure that we end up in a situation of balance over time. So this is on the exchange rate, and you may have some follow-up if you want. The last one on on fees and charges. What was the question? I know it's on fees and I could say.
If we're allowing them to.
If we are allowing them to
To hide
okay.
fees, yeah.
All right, I get. Now, I just wanted to be specific because we could go on and on about this. And we had a quite interesting engagement with the Joint Select Committee on this front recently. Let me start with the legal side and then go to the real action. Legally, the central bank has a certain mandate and certain legal constraint we operate under the Central Bank Act that says you can regulate certain things. In the sphere of fees and charges, it is only fees and charges related to those that are on credit facilities, on loans and so forth. So we cannot, by law, deal with fees and charges related to ATMs or surplus funds or deficit funds and so forth. We don't have this by law. But this is not enough, and clearly you should not be satisfied with something like that. Where are we now, and what should be done? We think it's a public or consumer protection issue that needs to continue to be addressed at different levels. And there are a few dimensions that are important. The first thing is consumer protection and power. People must know their rights and be able to exercise this. In many countries, you have what you call fair trading commissions, consumer protection agencies, and so forth. In Trinidad and Tobago, we don't have something like that. I think we have something like, but it doesn't include bank fees and so forth. So I think that part is important. The second part is on education. People must know what their options are and must know what they are getting into. What is the central bank doing in this area? Our role, as we see it, is to improve public education and transparency. I'll mention a couple of fronts. The first thing is our National Financial Education Program, or NFLP. And we are trying to move even more in that area to improve how we are explaining basic concepts and so forth. So this is gaining much more momentum. The second thing is that we are the second country in the Caribbean and of really few in the world to publish a schedule of bank fees and charges. Jamaica did it, I think, in 2004, 2009, I can't remember. 2009, following a big thing in the parliament and so forth. We didn't wait for that. We did it last year. We did it in, I think it was September 2016, based on 2016 June data. So we will be doing that every year. So the public education transparency is important. What can a consumer do? First of all, I said they need to understand what they're doing, educate themselves, but they may have problems still. The first thing I think you would do is to discuss it with your commercial bank. What is happening? What is going on here? If it's not clear, could you put it on your website? Could you explain it to me? You say, all right, well, you do that and you still don't understand it. To the extent that it's contractual and so forth, we have our financial services ombudsman. This is the only financial services ombudsman in the Caribbean, and only 4 in the Americas. The others, I think, are Canada, Peru, and the US. We are the fourth. So we have that established in 2003. We just had a nice lecture recently by Justice Kokaram on mediation. This is an avenue that people could go towards to understand their thing. Another thing that we try to do is on moral suasion. We meet with the banks quarterly, and we discuss things, all things very frankly, very cordially. It could get intense at times, but we like that kind of action. But we discuss fees, and the last 6 meetings, we discussed it 5 times. So it is part of what we do. Of course, it may not come out in what you may see, but we discuss it with them. Then we try to engage the public. As I said before, we appeared at the commission and shared our views, and we prepared to make our contribution in the different areas that we could. In other countries, it has morphed into things that are quite interesting. Like in the case of Jamaica, it's actually in the parliament now. There's a bill being put forward. In the case of the Eastern Caribbean, there's a joint commission including a lot of academics and so to look at the issue. So it is something that we are looking carefully at. Our market conduct division is looking at those things generally. We have a mortgage market reference rate that we would have just recently updated. So in that sense, that is also to improve education on mortgage fees and to improve transparency and so forth. But we see it as part of a whole network of consumer protection that involves potentially the central bank as regulator, but also education, consumer protection agencies, the Ombudsman, legislators, and so forth.
A couple questions, Governor, on your statement on the governance of corporations. And I want to start, and the role of the central bank in terms of ensuring that there is quality in the system. I want to start from a study that was done a couple of decades ago, actually, by Carl Paris, entitled The Interlocking Directorates, where he looked at the big corporations, the family corporations, the public corporations, etc., and found a lot of distortionary effects because of what he called the interlocking directorates. And of course, today, if you add to that the question of state financial enterprises, which have other kinds of considerations to meet, political considerations every 5 years, depending on the change in government, and we seem to be doing that every 5 years now. People get appointed to boards in financial institutions and give cause for worry because some of the persons don't have the kind of background that you talked about in your report. So the question is, have those practices changed over the last 20, 25 years? And is the central bank able to carry out its responsibility, its supervisory and monitoring responsibility with regard to these financial corporations? Second question has to do with government debt. Your report talks about it increasing, and while a lot of it is domestic debt, which means it can be manipulated is not the word, reorganized and renegotiated and so on in terms of repayment schedule. Is it growing to the level where repayment schedules can become unsustainable over a period of time? And the third question has to do with the foreign exchange purchases. They're increasing at the same time that the slide in the foreign exchange earnings, that slide continues. And I see a big figure here. I don't know if you have a breakdown of the figure of where the foreign exchange is going to, foreign exchange purchases. Where are they going to? What sector of the economy are they going to? And are they contributing or have the potential to contribute to the earning of foreign exchange in the long run?
I thought I had started off with saying 2 questions, but All right. Interlocking directorates. This is a very interesting one. And I remember I was at UE and with Carl Paris at the time and looking at his very interesting work on that thing. I think, let me generalize it, and then I could, say what we may be doing, bolstered by the Michelle team here. The issue of, coming back to the general point I made, the issue of independence of boards is important. Independence in the sense of integrity, in the sense of qualifications, and in the sense of courage to be able to do what they're supposed to do. So I think the points that we made there, the 7 points, would reflect or should be, could be taken to represent all boards. Now, have practices changed over time? I cannot say. I don't know what, I haven't been studying what has been happening there. I think in a small country, however, you have a particular issue. Because of the size of the country, you only have a certain amount of people, by definition, and qualified people, and qualified in the particular area. So you narrow down. By the time you narrow down, you may find the pool is quite narrow. But you have to make sure, I think, that they are able to do their job well and that they are supported. Now, to the extent that you have interlocking directorates now, I would suspect that some of it may be inevitable because of the talent pool and the experience pool. But I think the more important thing is how they actually operate and conduct their work. You could have an interlocking directorate or someone who's in different boards, but if they are sufficiently principled and sufficiently professional and supported, then they could do a good job. If they are not, then it could create its own problems. In terms of the central bank, able to carry out its responsibilities, you want to?
Yeah. Just to add to what the governor has indicated there, that is the question of the right composition of a board. That is a question a lot of regulators grapple with, and there's no one answer. It depends on a number of issues. But our Financial Institution Act does define what independence is. There's a definition, and you're required to have independent directors on your board. At a minimum, you should have at least 2 independent directors, although we stay away from. But because of the audit committee composition, it must be majority independent, and because you are allowed 3 persons for an audit committee, you must have at least 2 independent members on your board. However, we are not saying that is sufficient. So in terms of our supervisory practice, that is when we look at the functioning of the board. So that is through your review of board performance. You will determine, depending on the size, how the board is performing, if the board members are giving sufficient time to the duties, are they engaged in other board appointments, and they therefore cannot contribute as they ought to their board discussions. Look at the nature of the board discussions, the quality of the board discussions in terms of the board papers coming. That will also factor into how you review the quality of your board. We expect to have persons of banking experience, expertise, financial sector experience on your board, and occupying key functions. So it's not just a formulaic approach where we want you to have 4 persons, no interlocking directorships. We take a number of issues into consideration. So while there are some things specified in legislation, there are other things that we review in terms of practice and performance to make sure that based on the size, complexity of operations, that the board is composed in a way that will foster effective governance for the company. So
The question is, are you satisfied?
Well,
You talked about the abstraction, the ideal, but from your functioning, are you satisfied with how the corporate governance structure is in place and how it's functioning?
well, as Governor would have indicated, yes, in terms of the persons who occupy are generally required to fit and proper, but there is room for improvement in governance. And that is why we do our supervisory reviews and we make recommendations to improve the governance. And if there is an issue that we don't like, we will make recommendations in terms of the change of directors on the board to foster that change, whether we need to have better expertise on the board or some change needs to be made to effect better governance. So and fitness and propriety of boards and directors is an ongoing issue. It's not a one-time affair. So it's constantly reviewed.
All right, let me get into the second question. I mean, feel free to have follow-up questions on all areas. The question of debt. Clearly, debt is important for an individual, for a country. What is important? Let me just do a little abstraction here. The two main things are the level of debt, but more importantly, are the debt dynamics. What do I mean? If someone is heavily indebted, but they are just starting a practice, they have just qualified in dentistry or whatever, they don't have any funds. They could be a good bet, even though their debt is high, because they haven't earned anything yet. Contrast it with someone who just bought a Mercedes or a Porsche, and they just lost their job and they have all these things to do and so forth. And they are doing things that are not making sense. They could be just as indebted or slightly less indebted, but their prospects are much worse because they don't have an earning, and what they're using the money for is not productive, is not generating anything. So from this generality, what I want to come to is that levels of debt are important. We need to look at that. But more importantly, the debt dynamics and what we are doing. In our case in Trinidad and Tobago, it's important to recognize that we have a lot of buffers. We have the possibility of not getting into debt by drawing down the buffers. So you could do that. But more importantly, I think it's critical to have a strategy so that this doesn't continue over time. So your budget balance or whatever needs to be going in a certain direction so that you would not be constantly having to borrow and borrow and borrow more, including to not only pay off debt, but pay the interest in that. When you get the funds from the borrowing, it's important to invest it in productive things that would give the capacity to repay this over time, including not just monetary investments, but even building your human capacity, building your infrastructure, building your efficiency, your way of doing things, so that over time when the bill comes due, guess what? Your people are better prepared, your income is stronger, and so forth. So the burden does not occur because you have the capacity to repay it. So the debt dynamics are important. You mentioned two options or possibilities, as it were, the domestic side and the external side. And you sort of hinted that you could get away with domestic debt. So we wouldn't get into that because there's a whole understanding of that. In our case, on the external side, our debt to GDP ratio is quite small. As far as I remember, it was just less than double digits, which is good because now you have capacity, but you don't want to overdo it then. So I think we are starting from a position where, unlike many other countries, our external debt is quite small and manageable. In some other countries that have found themselves in debt difficulties, their domestic debt is a certain amount, but the external debt is much larger, and as you rightly hinted in your discussion, this could create major problems of debt servicing over time. So to summarize, I think, yes, the level of debt is important, but to me, the debt dynamics, what you do with the resources, how you plan your operations so that you would get out of this over time would be more meaningful to build the capacity to pay that. And the fact that we are skewed away from external debt is a good thing in our circumstance. I think the question on the forex purchases, where it was going.
Yeah.
Our numbers on forex or imports then really come from the balance of payments side, and unfortunately we have a gap in that. Getting the data on where it is going. Now, if you say what companies they are going to, that would be just a partial indication, because you would have, let's say, money goes to a commercial bank and it sells it to this company, it sells it to individuals, it sells it for credit cards and so forth. A lot of that is happening. So we have some general notion, it goes to certain companies, we go to credit cards and so forth. But what do you actually do with it? Is it for investment purposes? Is it for investing in certain transactions or tradable goods or so forth, or capital goods, investment goods? Some of this, unfortunately, we don't have. We don't have an indication now that there has been much change over the years in the pattern of the balance of payments. And so I can't say much more than that, unfortunately, except to say that we would have the basic data on companies and so forth, but that hasn't changed that much over time.
Governor, I have 4 questions on the foreign exchange issue. In his mid-year budget review, the finance minister said that he asked the central bank to direct foreign exchange distribution to manufacturers, and trade-related activities would have already been prioritized. Foreign exchange shortage or not, should the central bank be directing to commercial banks how to allocate foreign exchange trades to customers? And you have a situation where some members of the business community are already accusing banks of being unfair in terms of their distribution. The other question is, can you say what kind of trade-related activities are being given priority for foreign exchange at this time? And is priority being given to manufacturers who earn foreign exchange as opposed to those who don't? And are you aware of the growing black market for foreign exchange? The businessmen are very open. They're saying they cannot get all they want at the commercial banks, so they are getting it outside. Are you aware of the situation?
Okay, thanks for the question. It's supposed to be a financial stability report, but that's all. Foreign exchange distribution to manufacturers, should the central bank be doing it? Let me tell you what we do. We have, we don't have exchange controls. We don't tell the banks to give it to A, B, C company. So we are not into that. When we intervene, which, as I said, we intervene, meaning sell foreign exchange to the authorized dealers, mostly the commercial banks. This would be a small portion of what their overall foreign exchange inflows are, because they would get it from their customers, they would get it from wherever. So it's a small portion, 25% or whatever. What we say is that, listen, guys, prioritize your trade transactions, and we've been doing that for quite a few years. So it's a normal thing. As well as some of the over-the-counter customers and so, because you have other flows that can be used for different things. So to answer your question, it is not it is certainly not a direction for a specific company or a specific activity, or is it generalized and broad-based. It is just for the amount that we intervene in the market. Last time we intervened was, I think last week, for 75 million US. And 2 weeks before that, probably about 75 or 60, I can't remember exactly. But it will be just for those things. So it is a quite limited and general kind of approach. So related to that is your second question on trade-related. We don't get into whether it should be for this specific company, as I said, or what exactly is trade-related, or whether it should be for foreign exchange earners and so forth. It is quite a general sort of understanding that prioritize these, because in a situation where, first of all, you may have large customers that may have their own things, you want to be able to encourage banks or financial institutions to give to the small people and to those who may not have had access as a whole. So that's the question on trade thing. There was one on manufacturing. Again, this probably is related, but you could correct me if I'm wrong. On the manufacturers, again, it is not for specific ones, and it is not that if you have to demonstrate to us, certainly to the central bank, whether it goes to this one or that one or what activity there. I'd want to contrast that to the situation where we had many years before they had a floating of the currency, where you had the EC0 system. That is a completely different animal, where at that time the central bank would say everything has to be we had quantitative controls, we had a negative list, we had all those sorts of things. We had specific things, you had to come to the central bank, get approval, and then it has to be stamped, and then you go to the bank. We are not in those things. This is a general sort of indication to the commercial banks. And I would come back again to the points that I was making before on where we are now as a country, where we are in the early stages of a major transition. And so in the situation of disequilibrium that we are in macroeconomic situation that needs to be sorted out, we still have some things to finalize on the foreign exchange market, and I think over time, with the right policies and coordination, we will get there. There was a last question on the black market. Mm-hmm. Again, the central bank doesn't have specific. We don't send people out to look at A, B, and so on, and so to say, well, you have this black market and so. But clearly, in a situation of disequilibrium, there would be incentives for people to try to get whatever resource that they want, and this could edge up the prices in that thing. But we don't see evidence of a huge, major disequilibrium at this stage. Please.
Governor, when you say there's a disequilibrium in the foreign exchange market, would you care to explain exactly what it is you mean? And how does the central bank intend to cure that disequilibrium? Thank you.
Yeah, certainly. Disequilibrium means, and I don't want to be kind of given a preaching, or being too theoretical, but where we have an imbalance in demand and supply, where people want to get a certain amount and they don't get it. So we clearly have that in the context where we have a situation to address, which is the shock that we have. So that's what I mean with disequilibrium. In terms of the central bank role, as I said before, we look on it very broadly, that in this context, we have to have a combination of the right macroeconomic policies, of the fiscal situation, the structural, and then the monetary policy. To be more specific, what would the fiscal situation, how would that contribute or be part of it? Any country going through a situation like this says, well, what do you do? Your income is more than your income is less than your expenditure. We see that on the financial side, but the whole thing. So it means that there needs to be a process of adjusting the income to or adjusting the expenditure, to a level of income. This takes some time, and this is why you have the deficit situation that you have now. But this needs to be sorted out. In countries where you have, where they don't have policies other than income policies, then there needs to be a severe fiscal contraction. I'm not saying that you have to do it now, but timing is everything. you need to make some adjustment. The structural thing also needs to be sorted out, because in that regard, you have to be able to gear up. And I remember last time we had a very interesting discussion on re-engineering an economy. This takes some time, but in the short run, you may have some things that you need to get going in that direction. You need to have your business climate right, you need to have your incentives, you need everybody to play a part and so forth. The third aspect on the monetary policy side, the central bank, and when we get to our monetary policy report in a couple of weeks, we'll address that more frontally, is in a situation where it's very interesting, where we have, as I was kind of mentioning before, options on monetary policy. You could, let's say to put it starkly, you could raise interest rates, you could lower interest rates. We have some very intense discussions as to what to do. We have a situation where the economic environment may really warrant interest rates being at a level lower to encourage investments and so forth, and to stimulate the economy. But guess what? At the same time, you have interest rates externally going up. We have the Fed did 2 hikes. I was in Washington just a month ago at the IMF World Bank meetings, and Janet Yellen herself was there, and the more she spoke, the more aggressive she sounded before central bank cut it. Something happened fast. So now we have that thing to deal with. So we have to balance those things. So ultimately now, just to summarize, we need to get all the policies right and timed, and then central bank policy will fit into that overall milieu. Well, as I said, I don't think we on our own could cure it. It would not make sense. Monetary policy has a role, but it has to be in tandem with the other. If we try to take everything on our own, it won't work. For example, if I say, let's say if we said, well, let's put interest rates through the roof. But what happens to the economy? What happens? So I think as central bankers, we have to be a bit measured or humble in what our role could be. We'll be supportive, but we have to work within the context of everything else.
Hello. Well, connected to that then, what is the outlook for the central bank? What is the timeline before you guys decide we're going to intervene in the foreign exchange policy? I mean, you sort of said that you're going to take a wait-and-see approach, but what is that timeline? When is the point where you guys decide that, okay, it's time for us to intervene? And with regards to the banking sector, it seems, I mean, again, please correct me if this is my interpretation is different from yours. It seems that the burden is more on the consumer to take, it's more on the consumer to take an active role in determining which bank is better for them and which rates are better for them. And it's more voluntary for the banks. At what point, at what point does the central bank actually start to intervene in taking an active role in regulating these concerns that the consumers have? And what is it exactly that triggers sort of investigation into collusion? And since I'm here, I may as well ask you, when is the term up for the board of CLICO, and when will you all name a new board? And are you all concerned by the grandstanding, I suppose, by Mr. Dupré that he will take legal action against the central bank? Thank you.
Okay, thanks again for the question. The first one on the outlook for the central bank, I think I'm trying to just appreciate the question a bit more. Our perspective is that this year, things could get better. We have a situation where we have major investments and exploration in the energy sector. So we think this would bear fruit. But we have to wait and see. We have to see what's going on. I again want to be measured in being definitive on when we would do anything, because we have to be, we really have shortened our horizon in terms of looking at things. Our real-time data analysis is quite intense now. We look at everything every day because things are moving as we speak. And we have to keep in touch with that. But again, I want to emphasize that, now you had mentioned the word intervention. I don't know if you meant intervention as the sales of forex or just kind of when will we change what we're doing. If I'm to confine it to the first concept, just to reiterate, we do have a certain regular intervention path where we do it every 2 weeks, and we look at the level of foreign exchange reserves that we have. We look at the demand for foreign currency, we look at the supply, we look at market behavior, we look at what may be coming up and so forth. So we intend to keep that because we think it's important to have credibility and market, predictability in that sense. So predictability is important in this thing. So we are keeping that a predictable path of interventions. In terms of the amounts of it, if you have major changes, we will adapt. We do adapt. We look at inflows, outflows, and so we do adapt. So we will continue that that strategy. Or the okay. Well, again, the central bank's view is that we have to be consistent with all policies. And the only thing I would say is that we should not take any options off the table. Because as an economy that is adjusting to a major shock, you keep things in a toolbox and then you deal with it as it comes. So I can't be definitive because the world is moving, things are dynamic, and we need to be responsive and so forth.
But in terms of speed, then, I mean, I don't expect it to happen like overnight. You decide you're going to change the exchange rate, but what is it like? You're going to evaluate the economy for 6 months and then decide to change it, whether or not you should.
We evaluate it every day, every single day. We look at everything. Our daily thing on what's happening on indicators. So we look at it every day. The one on the, I think on the banking fees and charges, again, what would we do? I think we are pushing on all fronts. We are pushing on the public education front to make sure that people understand what's happening in their situation, in their banks, in their fees, what it means and so forth. We have an aggressive plan for public education, and it will include this thing. We continue to have regular discussions with the commercial banks. We have a meeting, we had the last one in April, so the next one will be soon. But we do engage with them on a regular basis, so we understand what is happening. We will be guided by the public agencies. We know that there's a select committee. We have engaged forcefully with them. We are committed to working with the legislators and so forth. So we are poised to take whatever role, and whether advisory or legal role within our mandate to work things through. But certainly on the public education side, we will be, again, by the end of June, by July or so, collecting the information from the commercial banks on fees and charges, and this will be, again, put out in the public domain. So on all fronts, we are working. Yeah, the last one on CLICO, I think there was a two-part question, was on the board of CLICO. Well, the central bank, as you know, is in control of CLICO. So we have different arrangements. We have, as we as we have it now, we have a board of directors, and we have the management and so forth. So this continues. The board of directors terms are, they have a year, and so it's probably a year to March or April next year. So that is standard. We have, after a couple of years of yeoman service, Wendy Hosing as executive chairman is leaving us, you know, because she worked with us and did a great job over the years, and she's leaving on, I think, the 5th of July. So we're working through the transitional arrangements in the normal course of things. So there's nothing really to report on that. In terms of you called the public posture by a former major person in the field, well, no, we do our job. I mean, so we do our job on the CLICO side to assure clean resolution. So we are not worried about anything.
I expect you decided, Governor, was that major individual that you referred to, would he be a fit and proper person for the central bank criteria?
Well, if it comes up, we will. I remember the last time we had asked that you had asked, or somebody had asked it directly, and I think our position is the same. We would have our views based on past information, based on past, as for anyone, based on what may have transpired before on different information and so. So in that sense, we will act accordingly.
I want to thank the public for viewing. I want to thank the staff. You see them here and you see excellent PowerPoint presentations, and I'm sure you can imagine the effort that the teams would have put into it, and I just want to recognize them. And I want to thank the media for your engagement. Thank you all for coming. I wish you God's continued richest blessings. Thank you for your questions. Thank you all. Have a good day.